Hey traders, welcome back to my channel, where today we're just going to cover how do we use commodities to help us get into better and high probability trades. So here we go. Here we are on a chart of New Zealand dollar Japanese yen. So we're going to have to change the chart because I've never tried to put the milk or dairy commodity on this chart. Could be interesting. We'll do some research and check it out. But for now, let's just go with what we know, which would be USD CAD. Okay, or what we trade, for example. So right now we're looking at the USD CAD. Okay, so if I wanted to take a trade on USD CAD, first thing is I would want to know what the interest rates are in terms of both countries. What is giving the investors more value for their money? Is it the US dollar or is it the Canadian dollar? Okay, the next thing I'll be looking at is how is oil affecting this currency? Okay, or how is oil affecting the Canadian dollar? So first thing I'll do, go on TradingView, type in oil futures. Okay, again, always change the color, guys, just to it generally never gives me an amazing color, but I want to be able to see it. Always pin to scale, edit to no scale, and then generally look at this. Okay, so there's usually a correlation between USD CAD and oil. What does that mean? So oil prices going up signifies downtrend or a drop in USD CAD, and all prices coming down signifies an increase in price on USD CAD. The reason is because Canadian dollar is highly correlated to oil. So as all prices go down, they affect the Canadian dollar negatively, ensuring that obviously the US dollar keeps moving higher and higher and higher. Okay. The dynamic of this is this relationship is not something that you can trade directly, but it's an idea of where oil is in terms of current price. The US, as they buy most of Canada's oil anyway, so therefore, this relationship is much more dynamic than this chart can actually show. But it is good to consider oil when you're trading the Canadian dollar. The relationship is quite straightforward. Easier relationship to be viewed could be the Canadian dollar Japanese yen. So this kind of shows you oil starts to move up, the price of CAD yen starts to move up, oil keeps going up, Canadian follows, and then you can see that oil actually starts to level off and fall, right? Giving a price divergence between the CAD yen and the price of oil. Canadian dollar also should be decreasing in value in terms of correlations, right? But this is not an indicator. It doesn't tell you exactly when to enter the trade. You need to see the dynamic of the relationship, understand that guess what? All futures are falling. So there is no way that you're looking for this currency pair to be shooting to the upside. Okay. In fact, you should be thinking to yourself, okay, fine. I should be looking for higher and higher entry prices. It's gonna be impossible to say this is the highest entry price. Okay, it's gonna be impossible to say this is the best entry price. But what you need to understand overall is to understand that guess what? It's not a buy. Okay, because you can see that all futures are falling down. If you were looking to buy this, right, you're buying against the trend of oil, which is highly correlated to Canada, and therefore you're saying that you're pretty much in a low probability trade. So you need to get out and just wait for price to guide you. And this is where price action matters. This is where you can implement the other filters which we learned, which is like the bond yields and how to use them in this kind of currency pair. I'm going to tell you guys that fundamentals have elevated my trading game to a completely different level in terms of investing. They've actually refined a lot of my trades and helped me get into trades that actually have a reason of why I'm in the trade. Okay, markets are too dynamic to look at them from one perspective. You always have to look at them from a few different perspectives so you can get the best understanding of what you're actually doing. All right. So another commodity that we're going to look at is the Aussie dollar. We are going to use gold futures. Okay, so we can put GC1 gold futures. If you do input the chart of gold here, again, it's not really going to make a difference because gold futures, you see that you can't even see the chart. They're in between there. So it's exactly the same thing. Highly correlated. Obviously, the Australia dollar is an exporter of gold. They have gold in them, their hills. So what we need to do is we need to understand how can we trade this. Okay, so we can trade this in reverse. For example, we can use, if gold moves first, then we can use it to trade Aussie dollar. or if Aussie dollar moves first, then we can use it to trade gold. But from what I've noticed is the Australia dollar does kind of move a little bit faster than gold, but the relationship is also interchangeable. For example, look at this. Australia dollar starts falling, gold only starts falling a bit later. But if you look at scenarios like this where gold is increasing, Aussie is decreasing, what does that tell you? Of course, if gold prices are going up, though that price has to eventually hit the Australia dollar market because commodities are sold in US dollars. Okay, if they are sold in US dollars, eventually you'll be getting more US dollars for your gold. Okay, so the price of gold is going up. Okay, that means you're getting more US dollars. Once you start to convert those US dollars into Australian dollars, guess what? You're getting more Australian dollars as the price of gold goes up. This also explains why there's a little bit of discrepancy between price and the commodity itself. Okay, because the commodity is priced in the US dollars and eventually takes a little bit of time for it to be converted to the local currency of Australia dollars, where they can see, you know what, we've actually made some money. This is where we are today. We still have to play a fundamental theme. Not only this is a gold price going up, the Australia dollar price will be going up, but we also have to remember the interest rates of the US could disrupt this relationship and we could end up moving downwards in both the commodity and the currency. So we covered oil and Canadian dollars. So just gonna summarize it for you here, guys. Oil and CAD pairs and gold and Aussie slash euro. Now, when I say slash euro, I just mean that I also change this chart to euro US dollar. So I can use gold as well to trade the euro US dollar. Okay, as you can see, there's quite a high correlation. And again, you just need to look at the relationships itself, back test them, and just find a way to, you know, test this relationship. Correlations don't last forever, but as you can see, when we're hitting lower lows on these prices, 116, I think it was around 116, 119. No, around 16. Sorry, as we're hitting these lows of maybe 1616, 1615, around that, euro is actually increasing in price, giving you the ability to understand that, guess what? If euro is moving away from the US dollar, gold will be moving away from the US dollar. So it's kind of like relationship where you can use. It's not a instantly directly profitable relationship. You just need to understand and keep all these factors as a trader, keep them all on your fingertips and use them as tools for the trade. Okay, literally use them as tools for the trade, just to get better entries, higher probability trades, just to help you understand which direction we're kind of looking at, and just to make your trading a little bit easier. So before you go on any chart, any currency pair that are just looking at the price action, you can use the fundamental economic indicators first to give you a general overview of the market, and then from there use price action techniques to be able to get better entries and high probability trades. And patience, guys. Some of these trades you have to wait for them to play out before you get your entry. You have to be patient. So it is the life of a trader. It is the life that you guys have chosen. It will be good to learn as much as you can in terms of trading so that you can be able to just have a better outcome as a trader, really. Okay, so patience, let the trade come to you, is always one of the most important things. And don't force the relationship. Correlations decouple and then they come back later on. There's a lot of fundamental dynamics that happen in the market. So happy trading and see you in the next one, guys. Thank you.